Well, good morning, everybody. My name is Mark Brownridge. I am Strategic Relations Director at Blackfinch Investments. So thank you very much for joining us today. It's great to see so many of you come along. So look, today we're going to be talking about VCTs, so venture capital trusts. We know this is a super busy time for you guys and girls as advisors, talking to clients about tax planning opportunities, tax mitigation, investment recommendations. We are very much of the opinion that VCTs might be able to help in some of those conversations that you're having. So the idea of this presentation is to look at the type of investors, who's investing in VCTs, what do they look like, what do they smell like, and hopefully that flicks a switch with some of you and you think, you know what, yeah, I've got a couple of clients who VCTs might be appropriate for. So by the end of the webinar, we're hoping to give you the confidence and the competence to talk to your clients about VCTs. Obviously, we have some super important information here. So we are, Blackfinch Investments are authorized and regulated by the Financial Conduct Authority. And any information taken in this presentation shouldn't be taken as legal, taxation, or financial advice. We are talking about VCTs. The FCA does classify them as high-risk, illiquid investments. So obviously, we need to give you the FCA key risks as well, which you can see on the screen here. Learning objectives, we have 4 of them today. You can see them on the screen here. We're going to go through them in as much depth as we possibly can. I've got about 20 minutes to run through them, and then we have a special guest joining us for the last 20 minutes, which I'll tell you a bit more about at the end. If you do have any questions, please do use the Q&A function down the bottom of the screen there. I'm sure we're all Zoom veterans by now, so we know how to use the function, but please do use that. We'll try and pick up the questions as we go through, and if we can't, we'll pick up more of the questions at the end. So, VCTs, what does the data tell us and what does this mean for advisors? So we've looked at the data, we've crunched the numbers, we've got insights from the statistics, because we know data is super important, right? Without data, you're just another person with another opinion. So what are the numbers telling us? So here we go. Over £2 billion invested in VCTs in the previous 2 tax years. Each of those 2 previous tax years have been record years for VCT funding. They've really come of age in the last few years. They're very much mainstream investments now, sitting alongside your pensions and your ISAs. We used to talk about them being alternative investments, but no, I think they've very much come into the mainstream now. What we're starting to see is a lot of people not just doing them as kind of standalone investments or ad hoc investments, they're doing them year after year after year after year. Very much part of the annual review process for a lot of clients and a lot of advisors now. As I say, it's an annual occurrence to do your VCT entitlement. So we can see that in some of the figures here. So you can see 12% of VC investors have 7 or more VCTs, 17% have between 4 and 6. So people are really starting to build a portfolio of diversified VCTs. If you've got 7 or more VCTs in your portfolio, that's probably over 100 companies that you're actually invested into. So we can start to see the importance of having a diversified portfolio already. So the market's really healthy. Demand side is really healthy. Supply side is really healthy as well. We're seeing lots of VCTs enter the market. There's probably about 13, 14 VCTs in the market. A couple have entered new this year. So generally, when we see a healthy demand side and a healthy supply side, we have a healthy market. And I think that's the situation we are in at the moment. Interestingly, this data is from Wealth Club. Wealth Club are an online discount broker. So these are clients going direct to buy their VCTs. Wealth Club are probably the biggest distribution platform of VCTs in the country right now, much bigger than most IFA firms. So if your client isn't doing VCTs with you, there's a good chance they're doing them direct with Wealth Club. So it's a good reason, another good reason to understand this area and get a bit more comfortable with it. We also have plenty of good news from the government in terms of VCTs and EIS. The schemes were going to be withdrawn from 2025 with what was called the sunset clause. That was an old EU thing that came in 10 years ago. But the government says, no, we like the schemes. They're doing exactly what we want them to do. We want them to continue. They help facilitate the smooth flow of capital from private investors to small early stage companies who otherwise wouldn't be able to get funding. So we want them to continue. So we have certainty, and it's going to be in legislation very soon, that the schemes will be continuing until 2035. So that gives us confidence as an investor, also should give you confidence as advisors talking about this area. Last point to make here, 50% are done before the end of the calendar year. So a VCT is not just for tax year end, it's not just for Christmas, if you like, it is also a year end thing. Most VCTs are evergreen, they're open all year. We know lots of clients are self-employed or company directors. They don't necessarily know what their tax liabilities are at tax year end. They find out at various different points during the year. So they can do their VCT during the year, get the tax relief because it's a very quick way of doing it. And also, importantly for them, they get invested quicker. So they're doing it earlier in the tax year, much longer growth opportunity to be able to get them some returns at the same time. So what's the average age of a VCT investor and how much they're investing? We've kind of broken this down by demographic groups. I'm just going to run through them all and tell you what they mean. So we've got our builders here and our baby boomers, so effectively people who are over 60. HMRC tell us that 46% of all VCT investors are retired, so that probably plays into the baby boomers here. A third are employed and 16% are company owners or self-employed. I think the important thing to make with baby boomers is that these are the lucky generation. The post-war children, it's a great housing stock, gold-plated pensions, lots of job opportunities, probably the most benign economic, social, political environment any generation have had. So they've probably been the luckiest generations of all the generations in mankind, quite frankly. And because of that, they've built up a lot of wealth. Over 70% of the wealth in the UK is owned by the over 50s. So as I say, they had the assets, they had the cash. They're also, in the last kind of 10 years, since 2010, income tax has gone up by over 70%. So they're also paying a lot of tax. So from a VCT point of view, they're the kind of perfect clients, if you like. They have money, they have cash to deploy. They've also got tax liabilities. So you can understand why a VCT is going to be appropriate for the baby boomers. Going down the other end of the scale, we have our Gen Alphas. Probably a little bit too early for my 14-year-old son to be doing a VCT. But certainly Gen Zers are starting to take an interest in this area. Don't forget, they've grown up with Dragon's Den, The Apprentice, Silicon Valley, if you've ever watched Silicon Valley, comedy show from the States. They understand entrepreneurialism. They get it. They're also super passionate people themselves. So if they're passionate about something, they will follow up and invest in it at the same time. And probably the best example I can give you there in terms of this is a TikToker. I'm sure you're all big TikTok fans out there. A TikToker called Josh Richard. He's only 19. He's just launched a venture capital fund, £15 million venture capital fund. He's going to invest in early stage companies. He's doing this because him and a couple of his TikToker mates, who he's going to join up with, have a social media following of 100 million people. So their reasoning is, that's 100 million people. That's 100 million potential clients for companies that we can let them meet, and obviously we're investing into, that could really disrupt the VC industry. So you can see they're passionate investors. And as Josh says themselves, we're Gen Z, we create trends, we start trends. That's what Gen Z do. So Gen Z is going to have a very different journey to baby boomers. Obviously, baby boomers have probably been in a job for 10, 20, 30 years, saved, invested, retired. Gen Zers will probably have lots of different jobs, lots of different income sources, and they're going to invest in a very different way from previous generations. So one to keep a watch on, Gen Zs. Gen X and Gen Y, so this is me effectively. So we're saddled with mortgages, we're saddled with kids, desperate to save up for retirement, desperate to put our wealth to good use. And also, like the baby boomers, we're pinched by tax. We're kind of that middle pinch sector, if you like. Again, HMRC tells us that average investors have around kind of 50,000 to 150,000. I think 37% of VCT investors are in that income range. So we have a good income. We are taxed quite heavily. So anyone who's Gen X, Gen Y, who has spare capital, again, a VCT could be a very appropriate investment. Just some number-wise in terms of how much people are investing. So again, HMRC gives some really good statistics here. They tell us that 29% of VCT investors have invested up to £50,000 in total, and 9% have invested more than 500,000. So some pretty chunky numbers there. HMRC unusually actually gives some really good data about the types of investors as well. So whilst we're looking at demographic groups here, they've gone into it in a little bit more depth and thought it might be worth just sharing that with you as well. So they've classified 3 types of investors. So the first one is savvy investors. So these are high net worth, experienced investors. They've got spare capital to invest and relatively large amounts as well. They're motivated by the tax release. They see their VCTs as almost like a hobby. They're excited to work with these companies. They're excited to invest in these companies. It's the classic, go and tell your mates down the pub that all these fantastic new AI and interesting companies you're working with. So as well as getting the tax release, they're excited. They're generating excitement through their investments. So that's the first group. Second group is what's called passionate investors. So similar to the savvy group, still high net worth, probably less sophisticated investment-wise, but they're much more motivated by their interests and areas that they're passionate about. So it might be the environment, it might be clean tech, it might be med tech, it might be a specific product or idea that they believe in, but they're investing with a very specific focus. So again, this might cut across any of these demographics, but that probably leans into what we're talking about with Gen Zs earlier on. And then the last group is what's called moderate investors. So these are groups who are not high net worth, they're not experienced investors. They're just looking for a tax advantage place to invest their cash. So they're not investing great amounts, it's smaller amounts, but their central motivation is the income tax relief. So that's our third group. And that probably plays into kind of the mass affluent group, maybe a Gen Xers and Gen Ys in the next example. So three different types there across these demographic groups. Importantly, over the next 30 years or so, wealth is on the move. So it's being classified as the Great Wealth Transfer. £5.5 trillion is going to move through the generations over the next 30 years. So those baby boomers, who I said a second ago, have built up all that wealth, have 70% of all the wealth, they're going to be moving that on, and either Gen Y or Gen Z, it might skip a generation, are going to be people that inherit those assets. So as an advisor, that's going to create winners and losers for clients as well, actually, in terms of who's going to inherit and who isn't. We're already seeing lots of disputes in the courts about who inherits. But for an advisor, it's a good opportunity to go and speak to not just to the person you're already speaking to, but to the wider family, so to the kids, the grandkids, and make sure you're involved in those discussions. Because as we can see there, 20% of people who inherit would not leave any assets with the same advisor. So that's a significant challenge to advisors to keep those clients. And a good way of keeping those clients is showing that you can add value. And a good way of adding value is adding in some venture capital to the portfolio, because we can see some increased returns across the efficient frontier here. So I'm sure you've seen a market efficient frontier hundreds of times before, but just to explain what's happening in this graph, we've got expected return there on the left-hand side. On the bottom, we've got standard deviation, so effectively risk. The blue line, the bottom line, is a classic 60% equity, 40% bond portfolio. So we can see there that we're kicking out at 10% standard deviation. We're getting a 5% return. All well and good so far. If we add in a bit of scale up or a bit of seed capital, so eventually venture capital, and this is denominated by is that blue or purple? Purple. I'm going to call it purple. We've got a purple line there, the top line there. So if we look at the effect of adding in some venture capital to that portfolio for the same risk level, so 10%, we're actually getting 5.5% return. So what we're seeing here is it's pretty clear that by adding in venture capital has a favorable effect. Portfolios with venture capital move closer to the efficient frontier, showing that we can improve returns for most levels of risk. I mentioned earlier that the kind of generally accepted theory is that VCTs are the next best tax advantage investment, cab off the rank, if you like, after pensions and ISAs. But what we're seeing here, the evidence we're seeing from Hardman & Co. is this approach doesn't always necessarily result in the best client outcomes. ISA investments, pension investments, VCT investments should be complementary and undertaken simultaneously. So the increase in the annual return by including venture capital that Hardman has found is between 0.5 and 1% per annum. So over time, compound interest will magnify those returns even more. So an additional, let's say, 0.7% per year on a lump sum for 20 years is going to give us a quite chunky 15% additional return on the final amount. So worth emphasising that we're not suggesting replacing pensions, venture capital, far from it. Only that the two investments should be done and built up in parallel. In summary then, just to tidy up this graph up, by introducing venture capital, we can push up the efficient frontier. We can see that there by that line. We can improve returns, Hardman tells us, by between 0.5% and 1% per annum. And we can do all of that without changing the portfolio risk for investors with a normal risk appetite. Look, we see the compound growth effect in this graph here, or the slide here, I should say. So what we're seeing here, year one, £20,000 investment, cost to investor is £20,000. We get our nice 30% income tax relief, £6,000. So we do that every year for 5 years. Year six, we've had the 5-year holding period for VCTs. The VCT exits this at this point. We're assuming a no gain, no loss. So we're getting our £20,000 back. What we do then, we simply reinvest it. So we've got the VCT investment at 20,000 in year 6. There's no cost to the investor effectively, but we do get another chunk, 30% income tax relief at 6K. So our cumulative income tax is building, helping to do exactly the same in year 2 for year 7, year 3 for year 8, so on and so forth. And it becomes really powerful when you look at a cash flow planning forecast here. So I'm sure many of you use many different variants of cash flow plans. Really powerful tool, and you can see the significant contribution that VCTs are making to this client's tax position. So on the right-hand side, this is seeing their tax without the VCT. You can see it growing. They're paying more tax every year. With the VCT, because of the income tax they're receiving every year, because of the exemption on dividend tax, they're not paying any tax on dividends they're receiving, and because of the growth in the VCT portfolio at the same time, they're paying significantly less tax if they make a VCT contribution. There's some additional points to make with younger investors or people who haven't invested before, or people who are dipping their toe in the water. First one to make is around underlying companies. Lots of VCTs are black boxes, so you won't be able to see what you're going into, but many will give you a good idea of what pipeline's coming through, so you can see what type of companies they are, what sector they're in, how they're performing. It should give you some idea of what you're going to get invested into. And obviously that's going to be important to tell your clients, because if you have a doctor who's really interested in medtech, that might float his particular boat. Or if you have a computer engineer who's interested in AI, that might be really interesting to them. So it's good to know what the underlying companies are in a portfolio. We've talked about tax a number of times. Obviously, we get the income tax relief with VCTs, we get the capital gains tax exemption on growth, and we get exemption on the dividend tax. So that's really important from a tax planning point of view. We talked about diversification with the Harman report a second ago. So we understand about the kind of additional return without the additional risk. But also these are uncorrelated assets. So they're doing something different from what your ISA pension GIA portfolio are doing. So they're a nice addition to that portfolio. And then accessing capital. So this is our last one here. So yes, you can access your capital VCT. There is a share buyback option. There's normally a kind of 5 to 10% discount, but you can get money back quickly if your client's circumstances change. I talked about demand of VCTs being really strong at the moment in the last couple of years. I talked about lots of VCTs being in the market, so supply side is healthy. But if you're selecting a VCT, what should you be looking at? So I've identified 5 things here. So again, cracking on with the diversification point, these are great diversifiers. They're doing different stuff to what your ordinary portfolio is doing. We've covered diversification quite a lot, I think. How quickly can you deploy funds? Really important one. You don't want to be sitting in cash for 6, 12, 18 months waiting to get your money into companies and working hard for you. You want to get your money away, deployed, and say start making returns, help that company going on its growth journey. What's the investment strategy? So talk to the founders of the funds. Have they been there and done it before? Have they worked with companies? Have they worked in companies? Have they actually been in one of these startups and understand what's happening? And then also understand what's their investment strategy. Are they specialists? Are they just doing medtech? Or are they generalists? Are they doing everything? Are they doing early stage? Are they doing late stage? Talk to them about where they're investing. Externals on the board. This is an important one. We always put a board observer at least, or hopefully someone actually on the board to work with that company. So we'll give them KPIs to hit. We'll give them milestones to hit. We're really working hand in glove with these companies to make sure they go on that growth journey. And then the last one, if founders have an incentive, do they know where they're going? Do they know where they're trying to reach? Is it an IPO? Is it a trade sale? How are we going to get out of this? How are we going to get clients' money back to them? Because as VC investors, we're not just chucking money at this company saying, let us know how you get on in 5 years' time. We're going on that journey with them. It really is a marriage in that sense. So it's important that founders have some skin in the game and are aligned with our skin in the game. I talked about VCTs, but most of what I said today can be applied to EIS as well. EIS, of course, is earlier stage, one of the most tax relief investments in the world. 5 tax reliefs, income tax, 2 types of CGT, inheritance tax, and of course, importantly, loss relief. And I always say about EIS, it shouldn't stand for Enterprise Investment Scheme. It should stand for economy, investors, and start and scale ups, because they're the 3 key stakeholders that EIS benefits. So economy, in terms of the significant contribution EIS makes in terms of revenue, people employed, taxes raised. If we added 1% more to the amount raised in the EIS, that would add £20 billion to the economy. So super important. Investors, obviously we talked about that, they get in tax release. Also, they get to go in on the first floor of that journey that hopefully a company is going to go all the way to the top floor and get some really good returns. And startup scale-ups, look, they need the money. Banks won't lend, building societies don't lend to these type of companies. Equity funding fills that gap, and EIS does that brilliantly. We like advisors. We work with lots of advisors. We have lots of content, lots of nice, pretty things for advisors. So we have fact sheets, guides, brochures, lots of webinars. Our head of ventures there talks a lot to founders. So there's lots of those videos. There's lots of kind of 101 videos around how VCTs work and operate. Please do check out the website. There's lots of information and lots of good stuff on there. We also have a client excellence team that can help you with all the nitty-gritty stuff, the application forms, the illustrations, etc., etc. Please do lean into them. And then we have a BDM team who can come and talk to you, come and work with you. Lots of them have been former financial advisors. They understand the issues clients are facing with BIS and VCT. So we have a great team. We also have a great investment team, which leads very neatly into introducing you to my colleague, Nic Pillow, who's going to join us. And he's our Senior Ventures Manager. And we're just going to chuck some questions at Nic so he can tell us a little bit about our proposition. Nic, hello, how are you? Do you want to introduce yourself?
Mark, yes. So my name's Nic Pillow, one of the senior venture managers on the investment team. My background is not actually in investment. It's in the types of tech startup that we invest in. I was part of a couple, and then I founded my own startup and ran that before joining Blackfinch about 4 years ago.
So there we go, someone who's been there and done it, as I was talking about earlier. So perfect. So look, Nic, I also talked earlier about when you're making a VCT investment, when you're choosing a VCT, we talked about the kind of criteria that you should look at. But as a VC investor or someone who's selecting companies, what key criteria are you looking for when you're investing in early stage businesses?
That's the magic question, isn't it? What really makes the difference? And I could probably talk about that for an hour, and it takes a lifetime to learn. But let me focus on really three key points. First and foremost, with these early stage companies, it's the team. You don't have all the usual company metrics that you might expect from a public company. It's very much, do these people have what it takes not only to make the business succeed in its current form, but will they be able to learn what they need in order to run the business in 4, 5, 6, 10 years time, when you expect it to be that much bigger and a very different beast to what it is now. And so it's that the characters, there's no one right profile. They all have to have passion and grit, because there will be a lot of challenges along the way. But otherwise, there are all sorts of different mixes of characters, and particularly different characters within a team that are really important. Do we think they are going to be able to deliver? And that leads into another part, which is the evidence of what they've managed to achieve so far. Yes, the problems they had in the past are different to the ones they have now and the ones they will have in the future. But have they been able to overcome those problems? Have they shown the right attitude and capability to find ways to deliver? And we particularly look at growth in revenue, but there are many other factors in the business. What are they set out to achieve? How close have they come to it? We don't expect anything to be perfect. Startups are very much a work in progress, but have they succeeded at what they tried to do? And then the third element, which is also really about evidence, and it's evidence of what we call product market fit. Have they created a product and identified a market for that product where the customers really, really want what they are creating, even though it's very early, it might be very rough around the edges and a bit crude, but does it satisfy some need they have where they say, yes, I want that. I'm willing to take it from this small untested company and rely on it for my business or for my personal use for consumer businesses.
Sure. You talked about product market fit there. I think there's 26 companies in our portfolio, but can you give us an idea? And I know this is a little bit like asking you to pick your favorite children, but can you give us an idea about what the strongest product market fit has been in the companies that we invest into? I guess what your favorite 3 companies are in the portfolio?
My favorite 3 companies, only 3 is the challenge out of 26. Well, let me give some different examples then. So we'll start with Uplearn. This is an education technology business, and I like it. It has got the very clear product market fit, but my own personal business was in education technology, so it's a good place to start. And they have an e-learning platform for currently A-level students, and they have a very simple proposition. You complete your course, that you complete their course for your A-level subject on their platform. And if you don't then get an A or an A star in your A-level, they'll give you your money back.
Right.
And a vast majority of people do get A or A star. 97% of people who take the course on Uplearn get that. There is such clear value, and these aren't the top performing students anyway. Some of them start with predicted Ds or Us. Whole schools are buying this, not just individuals, and it really delivers results. And they've seen some phenomenal growth as a consequence. It's actually one of the largest companies in our portfolio now. So really exciting to see that, and really helping children across the country, and they're expanding out beyond A levels to things like GCSEs now. So that's one, and that was a more recent investment we made last year. If I go back to one of the earlier investments we made, company called Attended. They've had a really tough journey. They were trying to launch their first product just as COVID hit the country. All their trials got cancelled overnight. I could give you more details of their journey, but where they've ended up is with a product aimed at the safety of workers. It's a geofencing technology, and it means you can define, for example, for railway workers, you can say, we are going to be working on this line, no trains running on that line, but nobody must stray more than a few centimeters beyond this virtual line, this virtual fence, if you like, because we've got live trains running on the next lines along. And then every worker has a physical unit. It looks a bit like a walkie-talkie, and it's got this centimeter level positioning in there, which says exactly where that worker is. And if they stray beyond this virtual line, they will be told in no uncertain terms. It flashes, alarm goes off, it vibrates. Everybody knows that you've strayed out of safe territory. And this is now getting rolled out. They've just won a huge contract with Siemens, and they've got some other really exciting big contracts coming along. So it's been a long journey, but they're now at this point where everybody wants their technology because it is going to save lives. And companies want it. They have a duty of care to their employees, but they don't want people to die. And it's getting very exciting. And so that was one of our early ones. And then to take something in the middle, and I suppose I like it because I'm the board observer from Blackfinch, a company called Currency. Now, if you go abroad, you want a currency card. And I don't know if you can see this. If I hold it in front of my face, you might be able to. You want one of these. It's a travel debit card. Lots of travel cards. This one will give you, the best rates. But why do you really want it? It's because it's so simple and easy. You do not need to set up a new account. You do not need to transfer money before you go and risk running out if you haven't put enough in there or put too much in and tied up all your cash. It just links to your high street bank account. And then when you pay, you get the best rates, without all the charges, but the money comes straight from your home account. It is so simple and easy to use.
It sits on top of your ordinary bank account, is it, effectively?
It just sits, exactly. It's like a different card for your own bank account, but it cuts out all the charges. It's fantastic. That is yes, doing very well. They've got a new product launching as well, and another one to watch there. Currency. I do recommend it. Go and have a look if you get bored with what I'm saying after this.
If you're off on your travels, it's definitely worth checking out. Exactly. Yeah. So look, you talked about Uplearn, Attended, and Currency there. Can you just talk us through kind of what you do as a VC, how you're holding your hands on those companies? I guess how we're obviously helping them to meet their ambitions. Obviously, for investors, that's super important in terms of returns.
Yes. So I've mentioned my background. One of the unique things about Blackfinch is most of us do actually have backgrounds as founders. We've started companies, we've run them. We know what it's like, and we know a lot of the real challenges of being in there. And that gives us, if you like, a unique perspective, but also unique ability to help with companies. So I mentioned that I'm the observer for on the boards of some of our companies, but that's not just turning up to board meetings. That's obviously working with the founders and getting stuck into a bit more detail, trying to help them with our own personal experience. And of course, it's not just my experience that I can help with on currency. We pool our experience collectively, and we review every company every month internally, and in fact with members of our investment committee who've got some very good experience as well. And look to see, okay, this is what's going on in this company. We've collected data from them, but how can we help? What can we do? What can we suggest to them that is going to make life easier for them? So that's quite a key part, just bringing all our experience to bear. But as Mark mentioned earlier, in addition to that, we then appoint directors to the boards of our companies from our wider network, our venture partners. These are people like Ashley Unit, who founded a company, New Voice Media, sold it for a mere $350 million just a few years ago. And he's very quiet, but he knows exactly what he's talking about. And we put him on the board of a company, and he just has this amazing wisdom and experience to bring to bear to help the companies as they scale. Or Geraldine Osman, another one who again founded a company, took it to the States, sold out to private equity, and she's fantastic at marketing. And so we have companies where they don't have a marketing function. They've been able to sell a certain amount, but they need to set up marketing. They don't know where to start. They don't know where to start hiring someone to run a marketing department. And so we can put her on the board, and then she will work with them, and she puts a lot of effort in, not just in board meetings, at really trying to get them up to speed with everything they need to do with a marketing team, a marketing strategy, and really get that side of things flying. So that's the sort of extra level of help and support that we can provide on top of our own expertise.
Sure. And then obviously I talked earlier about kind of some VCT firms are specialists, and might just be medtech or some other specialist area. Some are more generalists. So I know obviously we're a more generalist VCT investors, but can you give us kind of a flavour of where Blackfinch are investing, kind of sectors we like, sectors we're not so sure about? Just kind of give us about a general flavour of the asset allocation, I guess.
Sure. I mean, we say tech generalist. Technology is our mandate for the VCT, and it's also our expertise. So, I talked about our unique position as former founders, having run these companies. They're all tech companies that we've run. That's where we can really add value and where we can really understand what's going on. So we don't want to stray away from that sort of tech element in businesses, but of course technology is fundamental to so many sectors, and well, every sector and so many types of business these days. That's still a very wide remit, and actually what we are most looking for is then broad diversification across a lot of sectors. We didn't know COVID was coming along when we launched the VCT.
That'd be nice.
We don't know, we didn't know wars were coming along. We don't know what's going to be coming along next. What we need, what's really important is we don't put, all our eggs in one basket and say, this looks really hot at the moment. Let's put we'll make lots of investments in there, and then find that in next year or 3 years time, because we're investing for the long term here, something comes along in the world that undermines that completely, we've not only lost out on those investments, but we've missed our opportunity with this other sector here that's really taken off in the way that, for example, certain types of technology really took off during COVID, while hospitality and transport fell off a cliff. So we want that broad diversification. We deliberately look for it. Now, there are clearly some sectors that are sort of more topical, should we say, and coming into 2024 out of last year, AI is still really hot, but really hyped up. We actually have always thought that AI was quite interesting. I mean, I have a PhD in AI. I've always had that interest, and we do have a few companies in our portfolio that have some very clever, real, artificial intelligence, within them already. So we're quite happy with what we've got. Of course, we will look for more, but we will only, consider some more, AI companies if the fundamentals are there to justify the valuation they're asking for. And some people are still being very sensible about it. Other companies we've seen just in the last few weeks, the valuations they're expecting, at the stage of company are ridiculous, and we won't touch them. We don't need to, and it wouldn't make sense. Actually, where we tend to be more focused on the, if you like, the market sectors where these companies are selling into, rather than necessarily the nature of the technology that's behind it. And we do have very broad diversification already, from things like HR tech, I mean, fintech with currency I just mentioned, safety tech, marketing tech. We've got a couple of very interesting companies involved in online marketing and doing it in a way which doesn't use personal data, and so really we think the way that industry will have to go. But we're still looking for companies maybe in sectors like legal tech. A lot of room for innovation and improvement there. We haven't found a company that we're confident of in that space yet. And similarly in agri-tech, working with agricultural producers, some really interesting things going on, but not quite the right profile company yet. So if you know of any of those companies, do send them our way. We'd be delighted to take a look.
There you go. Please put in the Q&A if you have one. But yeah, every industry is a tech these days, isn't it? Agri-tech, legal tech, etc., etc. So the other question I was going to ask you mentioned about valuation as well. And last question, by the way, we hold this whole Silicon Valley thing around kind of growing fast and dying young. It's all about growth, not about revenue, and that's kind of been propelling valuations, the growth part of it. But how important would you say is that kind of conflict between growth and revenue?
I think there's a real danger of trying to chase overly quick returns. It takes time to scale a business. And you hear of some amazing stories, obviously, of invest in this company and it explodes overnight. But actually, some of those you also hear then dying a year later. What we think is really important is consistent growth, fast enough. You don't want to be just bumbling along sort of on a flat basis or tiny growth. You've got to have a certain level of growth in there, but keeping that going over multiple years. And I think it's interesting that there was some recent research by Wealth Club that showed that almost half the value of VCTs. Oh yes, I think you might have.
Here's one I prepared earlier. Yeah, literally. Thank you.
Might have the data. Across all VCTs, about half the value came from high growth companies, as opposed to only about a quarter of the value of the UK main market. So VCTs naturally have this higher proportion of high growth companies. And interestingly, yes, as you've highlighted there, the Blackfinch Spring VCT had the highest proportion of all VCTs, with 85% of our investments being from high growth companies.
The high growth is the green line, isn't it? This one here. So.
High growth is the green line. That's right. And it's only actually talking about a growth rate of over 25%. But this is the point. If we have a portfolio of companies that are growing more than 25% a year on year, that builds up. You've got your compound effect of that growth, which means over time, those are going to be big companies. They will deliver the revenue, but they'll do that sustainably over the period of time that we would expect clients to be invested into a VCT, generating the long-term returns. That is so important.
Sure. Nick, I said that was the last question. I lied because there's a question coming on the Q&A. So perhaps between us we can We can answer this one. So the question is, generally, for a client to exit a VCT after 5 years, the process and cost of this can be very lengthy and costly. Is this the case with Blackfinch?
Well, let me start. Maybe we have a buyback policy, so that after, well, we would expect after 5 years. Technically, it could be before then, but you'd lose your tax reliefs. You can sell your shares back to the VCT, because quite frankly, that there isn't really a secondary market for VCT shares. You'd be very lucky to find someone who wants to buy them secondhand, because they don't get the tax relief. Yeah, there is obviously a process to go through. I don't believe it's particularly onerous, but there is some administration involved. There is a 5% discount to NAV. Obviously, you will have had we would hope, certainly we intend, the 5% annual dividends up to that point anyway, and then it's your choice within a reasonable period as to when you would want the shares bought back.
Sure. And then I guess the company,
to add to that, Mark.
Yeah, I was going to say, I guess if you're exiting the actual company, so if you have an exit, you obviously got an offer come in from someone else to buy them or take them over or whatever. And obviously we've had one in the EIS portfolio, but I guess that can be quite a lengthy process, because it's obviously negotiations, aren't there, back and forth around kind of terms and valuation points and how that works and operates. But obviously that's all to the benefit of a client, because they're ultimately getting their initial money back, but hopefully a good excess return as well.
Yeah, I think that's the beauty of the VCT, is that all that complexity of selling investments in the companies we handle, and then for the client, it's just about selling their shares in the VCT itself, which is as I say, I mean, there is a process to go through, but the penalty is just that 5% discount to the NAV.
Well, Nick, thank you very much for joining us for 20 minutes. So I'm just conscious of time, but I could ask you 100 more questions, but I know we're trying to get it off by about 1:45. I don't want to take time from advisors. So thank you very much. Just to kind of tidy things up in terms of the rest of the seminar here, the rest of the webinar. The good old details, we all like our detail around what's happening, particularly with VCT. So just to kind of run through very quickly, the minimum investment for our VCT is 3,000. We're looking to raise around 20 million. Dividends, exciting news on dividends, because we do intend to pay a dividend. So we'll be doing that this month, and talk to your BDMs about in more detail about the dividend, how it's going to work, how that's going to operate. But yeah, very much this could be an opportunity to get a dividend from this month. Always looking for special dividends, so they'll hopefully come along as the VCT grows. Advisor charges up to 5%, ongoings up to 0.5%, promoter me of 2.5%, and the Blackfinch fee is 2%. Quite a high watermark for us, so it's 20% above £30. And of course, we do have some early bird offers, so you can see the offers down the bottom here. You'll actually do pretty well not to get an early bird offer, because we go all the way up to 3rd of April. So please do have a look at that. And then on the EI side, just to complete to the venture capital side of things, we're targeting return around 3% return. Our investment objective, as Nick has already laid out, is definitely growth. Initial fee of 3%. 2% per annum capped AMC, but only for 4 years. So it's very much aligned to your interests. After 4 years, we don't take an AMC. Performance fee, again, is quite high at 20% over 130%. Nick's talked again about the kind of target exit periods, so around 4 to 7 years is what we're looking at there. Again, we talked about exits through IPOs or a trade sale or various different options. So that's generally what we're looking for through an EIS. And there is the option, importantly, to be fully invested by the 5th of April to make sure you get all of your EIS this side of the tax year. I mentioned our learning objectives at the very start, so just to go back through those, yes, we've looked at the demographics of VCT investors, so we kind of saw the types of VCT investors that there are. We kind of know what they look like and smell like now. We can see how that can work with multi-generational clients. We talked about that kind of great wealth transfer, money moving around, different opportunities for clients, but also for you guys and girls as advisors. We've looked at how you can manage the risk within an EIS and a VCT portfolio. So we looked at some of the kind of risk mitigation possibilities that we can look at with these type of investments. And then Nick very kindly obviously outlined the Blackfinch Ventures investment process and walked us through that. So there's a couple of questions that come through. Actually, I'm just seeing if there's any more questions. There is another question, Nick. I don't know if we can look at this one. So, is there any reason why VCT shares after the 5-year holding period could not be added to a SIP as an in-specie transfer? Quite a technical question. I'm going to take that one offline if that's okay, and just check out the details of that and come back to you on that if that's okay. It is 10:45. I promised to get you all back to your desks and doing proper work by 10:45. But yeah, just to say thank you very much for joining us today. We know we've done lots of work on kind of consumer duty this year. I know you guys and girls have as advisors as well. We're all working towards the same aim here, which is trying to create better more positive outcomes for clients. And it's very much what we're trying to do with our BCT and EIS portfolios. So thank you very much for joining us and good luck with the tax year end.